You know, retirement planning can feel like you're trying to solve a puzzle in the dark. So today, we're going to flip the lights on and break down two really key pieces: qualified and non-qualified annuities. We'll get right to what makes them different and help you figure out which one might just be the perfect fit for your future.
It really all boils down to this one simple question. Your answer is the key that unlocks the entire difference between these two types of annuities. It shapes how your money grows, and it totally changes how you'll get to use it down the road.
All right, let's dive right in. To really get this, we have to start with the basics, defining our two key terms. And it all starts with one thing: where the money comes from in the first place.
Okay, first up is the qualified annuity. The easiest way to think about this is that it's just part of your regular retirement plan. You're funding it with pre-tax dollars, which means, and this is the big perk, you get a tax deduction right now. It's the classic "I'll deal with the taxes later" strategy.
And on the other side of the coin, you've got the non-qualified annuity. This one's funded with after-tax money. You know, cash that's sitting in your savings account or brokerage account. Since you've already paid the tax on it, you don't get any kind of upfront tax break. This is the pay the taxes now approach.
So you've got pre-tax versus after-tax. What does that actually mean for your money? Let's put these two head-to-head and look at four huge differences in how they work. This is where the real strategy comes into play. Okay, this is a big one. How the IRS treats your money when you take it out is completely different. With a qualified annuity, you never paid a dime of tax on any of it. So when you withdraw, the entire amount, your contributions and your earnings, gets taxed as income. But with a non-qualified annuity, your original investment comes back to you totally tax-free. Only the earnings get taxed.
Now this is a game changer if you're a serious saver. Qualified annuities are part of plans like a 401k, so you're capped by those annual IRS limits. But a non-qualified annuity, no IRS limits at all. You can literally invest as much as you want.
And that's exactly what this quote gets at. It's an amazing tool for what you might call super savers. Once you've hit that ceiling on your 401k and IRA for the year, this becomes your go-to vehicle to keep saving money in a tax-deferred way.
But what if you need to tap into this money early? Well, watch out, because both have penalties, but how they're calculated is totally different. For a qualified annuity, that nasty 10% penalty applies to the whole amount you take out. With a non-qualified one, the penalty only hits the earnings.
And here's the number you have to burn into your brain: 59.5. Just think of that as the magic number. It's the age the IRS sets where you can finally access your money from these accounts without getting hit with that extra 10% penalty.
Now, this is a massive difference, especially if you're thinking about leaving a legacy. Qualified annuities have something called required minimum distributions, or RMDs. Basically, the government forces you to start taking your money out. But with non-qualified annuities, there are no RMDs. None. You can let that money grow for your entire life if you want.
So what's that age? Right now, it's 73. As soon as you hit that birthday for any qualified plans, the IRS basically knocks on your door and says, time's up. You have to start taking withdrawals, which of course means you have to start paying taxes on them.
Okay, so just when you think you've got it all figured out, the rulebook throws us a fantastic curveball. There's this really interesting hybrid option that kind of cherry picks features from both sides, the Roth IRA annuity.
So here's the deal. Even though the IRS technically calls a Roth a qualified plan, it doesn't act like one at all. It's funded with after-tax money, just like a non-qualified annuity. And that one little detail opens up some incredibly powerful benefits.
So why is this thing so special? Well, it's pretty much the best of both worlds. Your money grows completely tax-free. Then, when you take it out in retirement, it's, you guessed it, also tax-free. And just like a non-qualified annuity, no RMDs while you're alive. It's an absolutely fantastic tool for leaving a tax-free inheritance for your family.
Okay, so we've put all the cards on the table: qualified, non-qualified, and that special Roth hybrid. How in the world do you decide which path is the right one for your specific goals?
Let's just walk through a few real-world examples here. Let's say your number one goal is to lower your tax bill this year. Well, the qualified annuity is your best friend because those contributions are deductible. But what if you've maxed out your other accounts or you just came into a large sum of money? The non-qualified annuity is perfect because there are no limits on how much you can put in.
So let's just boil this down. The qualified path is for you if your main focus is on getting a tax break today. It's all based on the idea or the hope that you'll be in a lower tax bracket when you actually retire, which would make that future tax bill a little easier to swallow.
The non-qualified path, though, is all about maximizing your savings and keeping total control. This is for the person who wants that unlimited tax-deferred growth and the absolute flexibility to decide when or even if they ever want to touch that money.
So there you have it. You've seen the paths. The choice between paying taxes now or kicking that can down the road really depends on your own financial picture and what you want your future to look like. Understanding how these tools work is truly the first step toward building the retirement you deserve.